Good Wednesday morning, everybody, and welcome to LeFonti International. I'm Alexandra Georgieva, and as always, we're going to be together right ahead of the opening bell and talking about the opening bell. Here's your price action 1 hour to the opening bell. The Dow is up about 166 points. S&P 500 0.4% higher, and the Nasdaq is up about 0.3% or 51 points after a little bit of selling, to be honest, throughout yesterday's trading session. Let me show you, of course, bond market situation, and not only, of course, front and center today is macro data, Fed Chair Powell testimony ahead of Congress, and not only energy prices, which are literally skyrocketing. So far, the 10-year Treasury at 1.78%, the 30-year Treasury at 1.14%, in the 2-year at 1.42. European bond yield slightly lower today. The spread between the 10-year Italian and the 10-year German bond so far at 156 basis points. Dollar index inching higher at the 97 mark. Euro dollar 1.1097. Take a look at the pressure. Euro certainly under pressure at 1.1095, below this key level 1.11 that we saw throughout yesterday's trading session. And of course, commodities, as I said, front and center. This is like incredible surge in crude oil prices so far. $111 per barrel when we talk about a WTI, and of course Brent $113 per barrel, both up about 5% throughout today's trading session. And of course, let me show you the macro data. Those are the United States ADP employment change, 475,000 new works in the private sector when it comes to the US. We saw a little bit of macro data today when it comes to MBA mortgage applications, MBA market index, MBA mortgage refinance index, and later on we're going to see the Fed Chair Powell testimony, not to forget the EIA crude oil stocks change and gasoline stocks change, along with heating oil stocks change and EIA refinery crude runs. This is important data. And let's just not forget inflation in Europe, which was certainly probably the most relevant macro data throughout today's trading session. Here in the Eurozone, inflation rate year over year 5.8% versus 5.4% expectations, month on month plus 0.9%, and core inflation rate year over year at 2.7%, 0.5% month on month. So once again, above expectations, both headline inflation and core inflation. This is going to be a headache for the ECB, that's for sure. From one side, the war in Ukraine, from the other side, inflationary pressures boosted mostly from energy prices. So let me bring to the show our first guest this morning, Mark Oswald, Chief Economist and Global Strategist, ADM Investor Services. Mark, good morning. Thank you for joining us.
Good morning.
Mark, we all know what's going on in Ukraine. Situation is pretty difficult. Most likely today we're not going to see the peace talks between Russia and Ukraine. What's your take on the market's reaction and specifically crude oil prices and natural gas prices? How concerned are you about what we are seeing today on commodities markets?
Well, I think that, we've had some outsized move, particularly in oil, definitely in wheat. The energy price pressures, given that we had the Eurozone inflation numbers earlier, and it was increased in energy prices above all, which pressured that higher. It's a serious concern, but what can central banks do about this? What we've heard today is there's about 4 million barrels of Russian oil, which is basically meant to be being shipped, but no one wants to buy it because it's Russian oil. Now, that sort of level of supply coming off the market, and then the IEA only announcing 60 million barrels, it does really sort of underline that SPR release that we're getting around the globe is a drop in the ocean. And woe betide us, I would think, today, if we see the weekly EIA data showing another drawdown on inventories. So the pressures are all there. And how it gets resolved is, it's very difficult. No one's expecting OPEC to increase output. To be honest, there's a credibility issue here also for OPEC because they're way behind now because countries like Iraq and some of the other Nigeria, Angola can't actually meet their quotas, the increased quotas. So if they decide to increase more, will people just react and say, well, you can't because you're not upping production? So all the pressure is to the upside, but nevertheless, the biggest concern, to my way of thinking, is this is effectively a parabolic move in a lot of energy prices. And at some stage, hopefully we will get a cessation of hostilities, particularly a proper one. And the risk is we get a crash bang wallop, creating even more volatility and more unpredictability in terms of the inflation outlook.
Absolutely. And talking about inflation outlook, I just cannot ignore the numbers that we saw today for the euro area. I'm just going to show our viewers once again, for everyone who's joining us just right now, 5.8% headline inflation here in Europe, of course, year over year, and month on month plus 0.9% versus 0.5% expectations. And we do also see from the chart that this increment compared to the previous month on a monthly basis. So Mark, I was wondering, is this the peak? And if this is not the peak, how the peak looks like?
What's the peak going to be? Well, that really depends on what people's views are on oil prices for one, or energy prices more broadly, so power also, because we've also seen thermal coal prices going absolutely into the sky today, because Russia is a major exporter of coal as well. But it's also the big risk is we get spillover effects, and you're starting to see that with the services, with the core CPI being driven up partially by services, because there's only so long that companies in whatever area they operate can absorb these input price pressures, and there's something that governments can do in terms of trying to cap the impact on consumers and on businesses, but there is a limit to that. This isn't, that subsidies are in the long run very ineffective. So, it really depends on all of this. People were counting on the big energy price base effects from last year, are basically starting to fade, and meaning things come down. They probably will come down a little bit, but it's not going to be to the sort of levels that central banks, be it the ECB, be it the Fed, be it the Bank of England, are going to be happy with. So, I think higher for longer is simply, and where the peak is definitely higher than most people had been predicting.
Well, let me ask you one final take. I was wondering, what are central banks supposed to do? From one side, of course, we have a military conflict in Ukraine. From the other side, surging energy prices, which are going to be a major contributor to inflationary pressures. And certainly they will have to trade off, specifically the ECB, or higher inflation, continuing with quantitative easing and low interest rates, or on the other side, aggressive or slightly more aggressive monetary policy, and of course, risking major financial crisis here in Europe, of course. So I was wondering, what are central banks supposed to do, in your opinion?
Well, I suppose there's two aspects. They can't really do much about a lot of the inflation. But what they can do is not feed the fire with quantitative easing. Doesn't mean they necessarily have to go into quantitative tightening, but some of the moves we're seeing is actually being fed by a lot of the excess liquidity that's going around, particularly the scale of the moves. The other consideration that they've also got, and this I think will come out perhaps with Mr. Powell's testimony, is they've got to look at financial conditions. We are going to probably see some quite big, some possibility of some dislocations, some market seizures, because people don't know what to do in terms of trade financing, and it will be it's one of those things where, yes, overall trade with Russia is only 150 billion, but if banks basically say, I don't know where the source of this money is, I'm not going to do anything on it, then that creates a problem with financial stability and financial conditions. And that's really, I think, where in the short term, very short term, their mind's eye is going to be very much focused.
Final take, Mark. I promise this is final take on Biden this time. Of course, he's facing pressure from Democrats and Republicans to be even more aggressive in terms of sanctions. On the other side, yesterday, he called for unity against Russia in State of the Union and said that of course, Vladimir Putin is going to pay a huge price, a high price for what happens in Ukraine right now. What do you think it has to be, how can I say, the positioning of the United States? And do you think that they have done enough, considering the fact that they are also in a very specific positions? What I mean is that they have to try somehow to calm down inflationary pressures. And this is very tied to crude oil prices.
Yes, absolutely. I mean, oil prices, or rather gasoline prices, are going to be definitely a highly sensitive issue, along with household energy prices in the US. I think the most important thing there are two important aspects here. One, it's the unity that's been shown above all with the leadership of the EU, the very surprising leadership of the EU over the weekend. And Mr. Biden, to a certain extent, needs to defer to the EU. Two, they can't do anything about no-fly zones, because that basically puts, people need to understand that's effectively a declaration of war, and that's the last thing that people need. And three, we really, really, really need China to step into this. China is going to be, whether we like it or not, the key mediator between these two sides. And whether we like it in the West or not, that's really going to be the critical element within this to try and bring some calm. That's at least my view.
Thank you very much, as always. Mark also, Chief Economist and Global Strategist, ADM Investor Services. Have a great day ahead, Mark.